Hello and welcome to Switzer TV. I'm Peter Switzer, and today I'm interviewing Jack Lowenstein. He's the CIO and MD at Morphic Asset Management. Welcome, Jack.
It's great to be here.
So, Jack, tell us about Morphic Asset Management.
Well, Morphic Asset Management was set up about 5 years ago now, and the aim was to try and offer investors what I thought I wanted, which was exposure to global equities, but in a very, very well risk-managed format.
Which sounds like what most people want. So just tell us about the company, and because you have listed an LIC, a listed investment company, and you have other investments. So tell us about the company.
So we have one unit trust called the Morphic Global Opportunities Fund, which has been going since August 2012, and we have an LIC which we floated at $1.10 for a share and an option, and that share about a week ago, and that share and an option are now worth about $1.14.
Okay, so tell us about the unit trust.
The unit trust has about $130 million in it at the moment. As I say, it's been going since August 2012. We've generated a total return for investors who came in of about 130%. So if you invested $10,000 when we launched, you'd have about $23,000 now. And we've managed to beat the index in that time, and also do so with very low volatility. And that's really our aim. We don't want our investors to be worried about their exposure to global equities. We want them to have very, very few sleepless nights.
And what's the minimum amount you can invest in it?
The minimum amount in that fund is $10,000. And one of the reasons we launched the Ethical Equities Fund, the LIC, was so that we could allow people who want to invest a smaller amount, $2,300, to invest in that.
Okay, so what is your unique investment strategy? You've alluded to it, but just tell us about it in a bit more detail.
I think our unique investment strategy is that we obviously we're very focused on a limited number of ideas around the world, but at all times we're very vigilant for what can go wrong, and then we act very, very in a very agile manner to address problems that arise. So, to give you an example, during Brexit, we were fully invested as voters went to the polls. Within minutes of the polls starting to be published, we'd cut our investments so we were 50% in cash. That's what I mean about being agile. Yep. So we were totally focused on the risks, and we were very vigilant about watching them, and we were acting in a very agile manner to cut exposure. And similarly, once it was clear the markets had bottomed, we got back into the markets very quickly.
Okay. Given the fact that you are aware of the big picture, you clearly understand the micro picture of the companies you invest in, but you're not ignoring the bigger settings. What do you think about the current macro settings for the global economy?
I think that broadly speaking, we're still in what we call the Goldilocks corridor. That is, things aren't going so crazily well that the central banks around the world feel they have to put up interest rates, which usually causes a bit of a slump in stock markets. At the same time, they're not going badly enough that we're going to have a recession. So while we're in that, as I say, Goldilocks corridor, we think the markets continue to go up, especially as earnings growth in almost every market is now starting to pick up.
So in a low interest rate world, is that affecting the way you invest?
It is, because I think, if you look back over my 30 years in investment, when we had very high interest rates when we started, obviously PE multiples were very low at that point. As interest rates stay very low, and we think won't rise that much, the market is justified in paying higher PEs, and people should recognise that. Yeah. But obviously there's a limit, and we're not interested in these in very crazily overvalued stocks. We would characterise ourselves as being a manager who looks for stocks that are too cheap for the growth they can achieve.
Yeah, which is a good approach to any investment, I think. The issues that keep you awake at night, you're happy about the Goldilocks corridor, but what's outside the corridor that might ruin that corridor? I
think a little bit less than there was, to be honest. I think the French election which was very recent, was obviously a concern for us. With the US elections are out of the way, I guess that Donald Trump's regime is a little scary, but I think I have a lot of faith in the US political system and the constitutional framework to mitigate those risks. But we talk about what keeps you awake at night. I grew up during the Nixon era, which is scary to think how long ago that was. And so I recently read a great book by Woodward and Bernstein, who are the guys who wrote All the President's Men.
Yeah.
After they'd written that book and after Nixon fell, they were invited to go and write a book about the final days of Nixon presidency from an insider's point of view. And they interviewed 400 people who in the White House and in Congress. And what was scary about that was when Nixon was a dead duck president, the stock market in the US fell 50%. And the US dollar was falling very hard as well. So if we get into that environment with Trump, that'll be scary.
So you would worry about any serious talk about Trump being impeached?
I would, I'm afraid, because I think that what that would probably imply was that the entire US administration would be distracted from the business of government to fight that impeachment process.
And the tax reform would go off the agenda, especially the magnitude that he's looking for.
Absolutely. Yeah.
That affects stock market. So where do you see value in the market currently?
Well, we're very attracted at the moment to Japan. We think there's a lot of very cheap stocks in Japan, which are assuming that Japan slides back. The pricing there is assuming that it seems to be implying that Japan slides back into recession, which we don't think is going to happen. Particularly, I should say, Tokyo. I mean, there's two economies in Japan. There's Tokyo, which has been growing pretty steadily, and the rest of Japan, which is a bit of a nightmare. So we're focused on Tokyo rather than Japan. We think India's still at a fairly early stage in a very long-term positive cycle. And we generally think EM is quite attractive, but we're more attracted to South Asia. So we also have a position in Pakistan. And Europe is looking more attractive than it has for years. So we presently have an overweight for emerging markets. We're pretty on market weight for Europe, and we're underweight for the US.
One last question. I did a budget presentation the day after the budget, and one thing I made a point that the last thing our Treasury needs is a stock market crash. And I said advisedly that I think a crash is still a few years off. Do you agree with me on that point?
I do agree with you. I mean, we're still below 6,000 on the Australian All Ords. I mean, we haven't made back our pre-GFC highs. So I think that the market here is already pricing in some of the inevitable stuff we're going to see, which is like a slowing in the rate of house price rises, and probably even a reversal. I guess the thing that is probably most scary around the world is that the markets have had a huge surge in property prices, by which I primarily mean Australia, New Zealand, Canada, UK. If there's any kind of very rapid bursting of that bubble, that could be nasty. I don't think it's a problem in the US. Most of the US has not had very, very high property prices. And people in Japan are terribly worried about the property price bubble there, because prices have been going up about 2% a year for the last 10 years. Scary stuff.
Yeah.
Not.
Jack, thanks for joining us. Well, that was Jack Lowenstein, the CIO and MD at Morphic Asset Management. I'm Peter Switzer. Thanks for joining us.